Stagflation is here, and the deleveraging has only just begun by Peruvian_bull. Now, this post is link intensive, has quite a bit of images as well. I will be showing those as they're relevant, but go ahead and just look into the description below to find the relevant links. This content is meant to be listened to. Specifically, this post here does have images and links that I do recommend looking into to get a full grasp of what the original author is trying to portray. But otherwise, you can still listen to it and come back later if you do so wish. The markets have been getting hammered lately, but I fear the carnage is just getting started. Major banks and equity funds are beginning to wake up to the new economic reality, stagflation. What is stagflation? Stagflation is characterized by slow economic growth and a relatively high unemployment, or economic stagnation, which is at the same time accompanied by rising prices, i.e., inflation. It can be alternatively defined as a period of inflation combined with a decline in the gross domestic product, also known as GDP. I discussed this at length in my first post of my Dollar In-Game series, where I explained that the Keynesian economist, academic/government economist who followed John Maynard Keynes' theories on supply and demand, believe that stagflation is literally impossible. This was due to an extrapolation of the Phillips curve, which basically implies that unemployment and inflation are negatively correlated. High unemployment greater than not enough jobs, greater than not enough money going to workers, greater than less demand for goods/services, greater than lower prices. Well, stagflation is officially here. On Thursday, April 28th, the U.S. Bureau of Economic Analysis released their Q1 2022 GDP numbers, which were down by a shocking 1.4%. This is the first GDP drop since Q2 of 2020 when the world entered lockdowns. The decrease in real GDP reflects decreases in private inventory investment, exports, federal government spending, and state and local government spending, while imports, which are a subtraction in the calculation of GDP, increased. Personal consumption expenditures, PCE, non-residential fixed investment, and residential fixed investment increased. Table 2. Disposable personal income increased $216.6 billion, or 4.8% in the first quarter, compared with an increase of $20.1 billion, or 0.4% in the fourth quarter. However, real disposable personal income decreased by 2%, compared with a decrease of 5.6%. Rising food and gas prices made up the bulk of the CPI increases. Along with the housing and vehicle prices, wages still haven't caught up, reflecting a drop in real income and thus a fall in spending. The American economy is a consumer-based economy, with around 70% of the GDP spent on personal consumption rather than investment or savings. When the price of inelastic goods rise, i.e., things that people need to survive, such as food, gas, electricity, and toilet paper, this leaves a smaller amount of funds available to be spent on vacations or cars, etc. With this fall in consumer spending will come a fall in most business revenues, which will mean bankruptcies, job losses, and asset liquidations. In short, we're in a recession, and it will get worse before it gets better. All of this is occurring as inflation figures hit 8.5% in March, a 40-year high. This is a deadly combination for any economy. As real wages fall and prices rise, everyday living gets harder for working-class people. Contrary to Reaganite economic thinking, their spending and work habit drives most of the value creation in an economy. So with more of them laid off and not spending, the economy begins to contract. Fed officials initially dismissed the idea that inflation could be anything other than transitory, but this idea was laughable as they had printed over $4 trillion in the space of 24 months since March 2020. This massive money printing was sure to show up in CPI figures, even ones that are as heavily manipulated as the current set, and set off a series of events that will eventually end in extreme inflation from my point of view. The ones who are getting beaten the worst are bond investors. After more than a decade of the Fed pinning rates to the near zero bound and keeping them there with QE, bonds were in a major bubble. In financial terms, most investors view them as risk-free, since Powell would always be there to buy them back at face value, leaving no chance of nominal loss and a nice small coupon payment as interest. However, with the Fed officially stopping asset purchases in March, really April, the tide is going out, and now these investors are realizing that the emperor has no clothes. Bond markets are getting absolutely obliterated, with funds experiencing massive drawdowns as a risk-off move appears to accelerate. In my opinion, the bond market sell-off has only just begun. 10-year treasury yields have ripped higher, reaching around 3%. However, in real terms, they are still negative 5.5% and not likely to recover anytime soon. Investors are pulling out of these funds at a rapid pace. 1 month ago, Bank of America noted that the treasuries had their third worst drawdown in a century. And all this just a week after the Fed ends QE. Bondholders are running for the exits. The issue that faces policymakers is a dull one. How do you fight inflation and the bond market sell-off at the same time? The cure for bond sell-off is easing. Money printing, lower rates, and the cure for inflation is tightening. No more money printing, push rates higher. They can't do both at the same time. So what the hell do they choose? High inflation, but bonds are face value, or low inflation, but bond market collapse? It appears they're trying the latter currently. Most people simply do not understand the vitality of fixed income markets in global finance. Bond markets can control policy action for entire countries. Economist Ed Yardeni coined the term bond vigilante to describe a bond market investor who protests against monetary or fiscal policies considered inflationary by selling bonds, thus increasing yields. Thus, by selling bonds, market participants can essentially call a government's bluff, forcing them to either print more money or allow yields to rise until they are an appropriate match for the default risk plus inflation rate of a particular government bond. For example, from October 1993 to November 1994, US 10-year yields climbed from 5.2% to just over 8%, fueled by concerns about federal spending and what became informally known as the Great Bond Massacre. With some guidance from Robert Rubin, the United States Secretary of the Treasury, the Clinton administration, and Congress made an effort to reduce the deficit, and the 10-year yields dropped to approximately 4% by November 1998. Clinton political advisor James Carville said at the time, "I used to think that if there was reincarnation, I wanted to come back as the president or the pope or as a .400 baseball hitter. But now, I would like to come back as the bond market. You can intimidate everybody." S&P 500 real earnings yield is the lowest in over 40 years, harkening back to the last major stagflationary period we experienced in the 1970s. As real incomes fall, earnings go down, and valuations start to matter. Wall Street priced in aggressive growth across almost every stock, but especially tech and software as service firms with high cash burn rates. Now that appears that it is starting to unwind. Volume premiums are on the rise, bonds and stocks selling off together, crypto getting liquidated across the board. It appears that the deleveraging is just beginning. In my post from November 2021, The Dollar in Game Part 4.2, Financial Gravity and the Fed's Dilemma, I examine how this exact scenario, Fed ending QE beginning to tighten into market weakness, played out last time in 2018. The Fed, with this trend of lower and lower interest rates in their vain attempt to kill the credit cycle, have created a financial black hole. The more they lower rates to get out and stave off default, the more debt is created, piling on more and more mass. This pushes interest rates even lower, which creates more loan demand and thus more debt, in a devastating feedback loop. This game will continue until the whole thing collapses under the weight of its own gravity. That, or they'll burn their way out with inflation. Guess which path they're currently choosing. There has been much discussion of a taper, that the Fed will stop printing money to buy securities and will raise interest rates to fight inflation. To me, anyone who believes they will accomplish this is being foolish. The Fed could barely get interest rates above 2.4% in late 2018, early 2019, before the stock market began to fall into bear market territory and the repo market blew up in September 2019. What makes them think they could get interest rates high enough to matter to fight inflation, above 7%, with the debt to GDP ratio 30% higher than it was in 2019? Each time they begin this taper program, the markets react violently. Addicted to the heroin of easy money and low interest rates, the prisoners of this system, the banks, and the US Treasury itself are up to their eyeballs in debt, and any attempt to offload that debt is vehemently opposed. Disconnecting the Fed's liquidity hose results in an immediate withdrawal, and it must be put back quickly if the Fed wants to avoid a full-blown deleveraging event. Deflationary spiral. The prisoners demand ever-increasing liquidity, more and more QE, and tapers become ever shorter and fewer. The inmates are running the asylum. Buckle up. Nothing in this post constitutes investment advice, performance data, or any recommendations that any security, portfolio of securities, investment product, transaction, or investing strategy suitable for any specific person. From reading my post, I cannot assess anything about your personal circumstances, your finances, or your goals and objectives, all of which are unique to you. So any opinions or information contained on this post are just that, an opinion or information. Please consult a financial professional if you seek advice. If you would like to learn more, check out my recommended reading list here. This is a dummy Google account, so feel free to share with friends. None of my personal information is attached. You can also check out a Google Docs version of my in-game series here. And you can also follow me on Twitter at Peruvian_bull. All other accounts are impersonators/scam accounts. Thought sauce here, and I just want to thank everybody for listening here today. If you have any recommendations on what DD I should read next, please go ahead and comment that below. And thank you for listening. Remember, DRS and ape don't fight ape. Have a good one.